Here are 5 problems on cost, volume, profit. Slow movers develop the following unit amounts for one of the divisions that manufactures one product. We have sales price 90, variable cost 54, contribution margin 36, fixed cost 432. Answer the following independent questions, and show how you got them. Number 1, break even. Well, break even in units, okay, is equal to the fixed cost, 432, divided by the contribution margin per unit, which is 36, and you get then 12,000 units. Okay. What is the total sales in dollars that must be generated for the company to earn a profit? Okay, so therefore, sales required, it's in dollars. So therefore, I have to go and get the contribution margin ratio. And the contribution margin ratio is 36 divided by 90. So therefore, the sales required is equal to the fixed cost plus the desired net income of $50,400 divided by the contribution margin ratio, and my answer is 1,206,000. Now, number 3, if the company is presently selling 14,000 units, but plans to spend an additional $135,000 on an advertising program, how many additional units must the company sell to earn the same net income that it is now making? Well, first I have to figure out what is the net income that they're now making at 14,000 units. And then how many units will they need to make that same net income if I increase my fixed costs by 135,000. And so we will first of all determine the net income. The current income is 14,000 units times the contribution margin on each unit minus the fixed costs. So it's 14,000 times 36, that's my total contribution, minus the fixed cost of 432, and I have a current profit or net income of 72,000. Now they want to know, if I put another 135,000 into advertising, now you have to ask yourself, what kind of cost is advertising? That's a fixed cost. So the contribution margin remains the same because there's no change in the variable cost or the selling price. The only change is the fixed cost. And they want to know, how many units do they have to sell to cover the new fixed cost as well as the old one and give me 72,000? Well, that would be the old fixed cost of 432 plus an additional 135 for advertising plus 72,000 profit. I need 7 divided by the contribution margin, should put that in there, of 36, and I need 17,750 units. The question asked how many additional units. I'm currently selling 14,000. I need to sell 17,750. The additional units is 3,750. Speaker Box Music Inc. produces hip-hop CDs that sell for 15. Contribution margin ratio is 30%. Fixed expenses total 6,750. Compute the variable cost per unit. Well, if the contribution margin ratio is 30%, then the variable cost ratio would be equal to 70% of selling price. And 70% of selling price, 70% of $15 is $10.50. So the answer, compute the variable cost per unit. The variable cost per unit is $10.50. Per unit, you must realize that the contribution margin ratio is a percentage the contribution margin is of selling price. Therefore, the variable cost ratio is the complement. If the contribution margin is 30, the variable cost is 70. How many CDs Well, they have to sell in order to break even. Now, these are in units, so we have to come up with a contribution margin per unit. The selling price per unit is $15. The variable cost is $10.50. Contribution margin is $4.50. So for B, we want the break even, and that would be equal to the fixed cost, $6,750, divided by the contribution margin per unit, 4.5, and I have an answer then of 1,500 units to break even. C part, compute how many CDs they would have to sell in order to achieve a target net income. Okay, well, target net income, which is target TNI, is equal to the fixed cost, $6,750, plus $16,200, divided by the contribution margin per unit, and what I have is 5,100 units. In D part, they say, okay, now take that 5,100 units and tell me what the sales revenue will be. Well, 5,100 times 15, the sales revenue would be 76,500. The variable cost then would be 5,100 units times 1050, which would be 53,550. Or you could have taken 70% of 76,500. The contribution margin, the difference between them is 22,950. The fixed costs are 6,750. And therefore their profit would be 16,200, which is exactly what we wanted. And that was the answer from C and D. Jaguar Inc. earned net income of $100,000. Okay, nice. Company wants to earn now $140,000 next year. Okay. Fixed costs $56,000. Variable costs $30,000. Well, again, if the variable cost ratio is 30%, the contribution margin ratio is equal to 70%, the complement. So determine A, the required sales to meet that net income. All right, the required sales is going to be the amount I need to cover my fixed cost of $56,000 plus the profit of $140,000, all divided by my contribution margin ratio of 0.7. And my answer to that one is $280,000. That's my required dollars. Fill in the dollar amount based on the net income. All right, so my sales revenue then would be $280,000. My variable cost would be 30% of that, 280, which would be 84,000. Contribution margin then is 196, and I subtract my fixed cost of 56,000, and I have profit of 140,000. Just what I would have predicted. Tractor Power Inc. estimates the variable cost will be 55% of sales, and the fixed cost will total $297,000. The selling price is 120, and the number of units sold 5,600. And they want to know how many do they have to sell in units and in dollars. So therefore, we have over here the selling price is 120. Okay, the variable cost is 55%, so we take 55% of that, and that equals $66. Therefore, the contribution margin would be the difference, $54. Now, we know the variable cost is 55%, so the contribution margin ratio is the opposite, which would be 45%. So there we have the data. They want the break even in units, and therefore it'll be the fixed cost, $297,000, divided by the contribution margin per unit, which is 54, and my break even then in units would be $5,500. Or units, sorry. Now, if they wanted to break even in dollars, in this case, we could just take the number of units, 5,500, multiply by 120, and I get 660,000. Or I can take the 297,000, divide by the contribution margin ratio, which is 0.45, and I will get the same, 660,000. And that is dollars. Now, how much can sales fall, decline, before we're in a loss? So this is the margin of safety. And they want this, I guess, in dollars. So B part, what we want is the margin of safety in dollars. Margin of safety, whoops, can't get that, in dollars is equal to the current sales. And the current sales is 5,600 units times $120. Okay. $672,000 is the current sale, in excess of what they need to break even, 660. So therefore, they have a very small cushion, only $12,000. Sales only have to fall $12,000 sales revenue, and we are going to be in a loss position. So it's a kind of a risky company. Remember, the margin of safety is the current sales minus what I need to break even.